It's been a bit of a difficult year for the Malaysian economy. GDP growth has slowed in the first 3 quarters, and while we expect growth to pick up in Q4, we do think that growth momentum is much slower than it was in 2022. Our forecast for 2023 is that GDP growth slows to 4% from 8.7% in 2022. That said, going into 2024, we are a bit more optimistic. I would say we are cautiously optimistic about Malaysia's outlook. We do expect growth momentum to improve marginally to 4.2% from the 4% this year, and this is premised on 3 major factors. First, we see private consumption growth stabilizing as we go into next year. If you're looking at private consumption growth in Malaysia, which is essentially household spending, however, since 2019, private consumption growth has been volatile. It has been oscillating anywhere between -8 to +8%, and this has made GDP growth also quite volatile, given that the share of private consumption in growth is quite large. Going into 2024, we expect that there will be stable or more stable real and nominal wage growth, which will help support private consumption. Hence, we expect the growth rate to stabilize around 4% next year. In addition, we also see infrastructure spending, as promised by the government, pushing through and bolstering growth. The government, in the course of the second half of 2023, has announced numerous medium-term economic plans. And one crucial part of the agenda has been to strengthen infrastructure and logistics. To that end, the government has announced 11 new projects that will push through on infrastructure and logistics, and we expect that as spending improves on these projects, it will continue to support growth. Finally, on the external front, even though we see global growth slowing next year, we do think that the electronics down cycle, especially on the export front, will bottom. And this will help support overall electronics and manufactured exports from Malaysia. Manufactured exports are actually the lion's share of exports in Malaysia, accounting for about 60% of total exports. A better manufacturing or a better electronics export outlook will help support growth. So based on these 3 factors, first, normalizing private consumption, second, better infrastructure spending, and third, a bottoming of the electronics down cycle, we see better growth in Malaysia next year. Furthermore, to complement these 3 factors, I just mentioned that the government has announced a flurry of medium-term plans in the second half of this year. These include the National Energy Transition Plan, as Shuhei has mentioned already, the new Industrial Master Plan 2030, the review of the 12th Malaysia Plan, the 2024 budget, as well as the introduction of a more stable medium-term fiscal framework. Now, taking it all together, these plans basically put Malaysia's economic policy-making agenda on the right trajectory over the medium term. They set goals for the government to achieve. They also look at ways and means for the government to achieve those goals. Now, from our perspective, the most relevant and the most important plan, at least in the near term, is the plan on fiscal consolidation. In Budget 2024, the government has very clearly hit the right notes in terms of fiscal consolidation. They expect the fiscal deficit to narrow to 4.3% of GDP from 5% of GDP this year. Much of this narrowing is premised on the fact that they will introduce a subsidy rationalization methodology for retail fuel prices. Now, the exact way and time at which this subsidy rationalization will be announced for retail fuel prices is still unclear. However, the numbers suggest that there will be an 18% drop in subsidies and social assistance spending next year based on fuel subsidy rationalization. We will look forward to more details from the government in terms of how exactly they want to achieve this rationalization. But the one thing that we understand is that a lot of the rationalization is based on the introduction of a central database known as PADU. The PADU database as of November was 72% complete. It's a socio-economic database which provides details of households so that subsidies can be targeted towards the right households. The database will be in full implementation by January of next year, according to the government, and this will be a key implementing tool for fuel subsidy rationalization next year. At the same time, and not less importantly, the government has announced new tax measures to bolster the tax base and broaden it. Petroleum revenues over the last few years have been an important contributor to overall revenues. And in the next couple of years, we do see the need for the revenue base to broaden. To that extent, the government has announced an increase in services tax, a capital gains tax, a luxury tax. All of these will help broaden the tax base. At the same time, the elephant in the room is clearly the goods and services tax. There has been talk that the goods and services tax is still on the table. It's not a 2024 story in our view. It's more like a 2025 story. So we will continue to monitor what happens on that front. But for now, the increases in the tax base are non-GST related. With fiscal consolidation clearly in play, the government will, in time, reduce debt levels, and this will be credit positive for the Malaysian sovereign. In general, we see Malaysia's economic outlook, fiscal outlook, inflation outlook, and growth outlook to be quite resilient in 2024. When we tie together a story of resilient growth, relatively well-contained inflation, continued fiscal consolidation, we do see that there is limited need for Bank Negara Malaysia to actually change rates next year. BNM hiked its policy rate in May of 2023 and has since then kept the policy rate unchanged. Even with our house view of the US Fed cutting its policy rate by 100 basis points in 2024, we really don't see the need for BNM to adjust policy rates, partly because first, the upward adjustment in the policy rate by BNM was a lot lower than regional peers. So at 3%, the policy rate is more or less at where it was at historical levels. Second, unless inflationary pressures go wary, we do think that inflation will remain contained, even with the government subsidy rationalization plans. And this will further support our view that BNM does not need to change its policy rate. As such, it's a cautiously optimistic story for Malaysia in 2024. And the main risks that we will watch out for are twofold. One, on the external front, we will continue to look for risks around a US hard landing, which will mean that growth in Malaysia will be impacted due to weaker external demand. And second, on the domestic front, we will look for continued push in reform momentum. As long as the government continues to achieve on its fiscal deficit targets, its medium-term reform targets, we will remain optimistic that growth is supported by domestic demand factors.